Hello fellow investor, in this video I will explain how to roll option in Interactive Broker. Rolling option is a key part of any option strategy, and sooner or later you will need it. So it's important to understand the process to do it and the reason why. Many think that rolling option is too complicated, and also Interactive Broker is a little bit too much for the usual retail investor. I know, I get it, it can be intimidating, but trust me, if you know it step by step, it will be quite easy. I roll option all the time, both on the desktop version or on the TWS, and trust me, I'm not an expert of advanced trading strategy at all. So I will first explain what rolling option is and why it matters, and after we'll jump into Interactive Broker and I will show you step by step the process to do it. As always, if you are in a hurry and you cannot watch the full video, shame on you. You can just use a timestamp and jump to the chapter that interests you the most. What is option rolling? Rolling an option, it's easy to explain. Basically, you close your actual option strategy and simultaneously you open a new one. If you sold a call option, for example, you buy to close the current call option and at the same time you sell another option on the same stock with a different expiration date or strike price. The key word here is simultaneously. Brokers allow you to set the condition of both legs of the trade, ensuring the transaction only executes if both conditions are met. This way, you know exactly how much you will get from the roll. Let's just make an example. Let's say I sold a covered call on Apple at $170 strike price, expiring, next Friday. I collect my $2 per share when I open the position, meaning I receive $200 in premium since each option controls 100 shares. Now, a few days before the expiration date, I noticed that the price of Apple raised to 172, for example. So if I don't do nothing, I will probably risk to lose my share. So I decided to roll the option. I close my current 170 call and I open a new call to a later expiration. For example, I can buy the 170 call for about $3 and at the same time I sell a new call, maybe a 170 strike price expiring, in 1 month and collect 3.5. By doing this, I pay $3 to close the old option. I receive 3.5 for selling the new call and I get a net of 50 cents overall, which means $50 in my pocket. Plus, I push the expiration date further, I raise the strike price, so now the stock have more room to grow before I will get assigned. Don't worry, we will see similar example later in the video inside the Interactive Broker platform. But why is necessary to roll an option? There are 3 main reasons to roll an option, and while the first 2 are quite obvious, the third one is probably the one that will really increase your profit. The first reason is to extend the trade if the stock hasn't moved as expected. Let's say you are bullish on Apple and you buy a call option with expiration date in 1 month. After 20 days, the stock moved in your favor but hasn't reached the strike price yet, so most probably you will just lose your premium. By rolling the option, you sell to close the current contract, you buy another call option with a further expiration date. In that way, you give the stock more time to reach your strike price and to validate your trading idea. Another reason, which is the one we saw before, is avoid assignment when holding a short option close to expiration. This is very common with covered call and it happened to me all the time. You sold a call on your stock, you are close to expiration, strike price is near to be triggered and you don't want to lose your stock basically. So what you do? You just do a rolling, you extend basically the expiration date. Yes, you will lose a little bit of premium, but you will not going to lose your stock at expiration date. But the third point is the most interesting one because it helps you to maximize your gain. This has happened to me very often, especially if you sell a covered call on dividend stock like it. Imagine you sell a 1 month covered call on one of your stocks, so you get your premium. Let's say after 15 days the stock didn't move at all or even went down, so it's pretty clear you will never get assigned. You could just wait for expiration or you can roll your stock. You buy to close to a very small amount because the value of this option contract is very low because we'll never get assigned. And at the same time you sell another covered call at a lower strike price. Now, in just 1 month, you collect twice the premium. So when the outcome of the option trading is already certain, there is no reason to wait the expiration. Just roll it, enter in a new contract so you collect the premium twice. Okay, I know that was a lot of theory. Let's now jump into how to roll an option on Interactive Broker. I will now walk you through two examples on the two different platforms, the desktop app and the TWS. The process is of course the same, but the broker interface is a little bit different. Okay, so let's start as suggest from the TWS and after we'll switch to the desktop app. So right now the market is open, we are on Wednesday. It's not a very situation for the market right now, I think we all know why. Anyway, this is my portfolio, let's forget about how negative it is right now. And these are my two options. I booked a call on Kraft Heinz with expiration date 11 of April. And I have a covered call, so I sold a call on XLF, which is an ETF. I made a lot of video about XLF, check in the description, there is a full playlist about that. So this one is a covered call. You can see from here to understand which one is a call, which one is a covered call. The covered call is a short, so it's -1 the position. The call option is not a short, so is position 1. Okay, let's forget the average price I used to purchase that, because I did only for the purpose of this video, so it's not very important. So for the TWS, I will try to roll the call. So let's select the call right here. Just a small recap. We see this is my entry point, the line in green. This is the situation right now. The call is priced at 0.1. as a premium. These are the detail, expiration date 11 of April at 29 strike price. Let's now roll it. We need to do right click on the call, and on top we can buy another one or even more. We can sell it or close it, which in this case is the same, and we can roll it. So let's just click on roll and it will open this I hate the TWS, it's like looking at old Windows 95 or even earlier. Anyway, the system already tells us that we need to sell the call, which is exactly the same call because we booked a call, so we have a call in our portfolio. We need to roll it. As I said before, we need to first sell it and then buy another call. So this is already priced in right here. It's telling me that the bid and ask is between 0.1 that we saw before right here, at the moment is 0.1 and 0.13. It depends on what will be in the exact moment. And it tells us, okay, let's now buy another call. Let's add another leg to this option trade. Let's say, for example, that we are close to the expiration, because expiration is in 2 days. We are far from the strike price, which is 29, because at the moment Kraft Heinz is trading at 28.05. So I think this call will be useless. And we will try to extend the expiration date. So we go, for example, in 8 days, and we can buy the exact same call, or even we can buy a little bit higher strike price, like 29.5, just to pay a lower premium. Let's see, for example, this one. So we selected, and we see that they add a second leg in the option trade. So the first leg is selling the call that we have, the second leg is buying a new call. It's telling us that the net amount that we are going to pay is around between 0.2 and 0.13. Why? This is, I hope, will be clear. The first one is selling a call, so we will get a premium. Our premium is between 0.1 and 0.13. But after we buy a call, so we pay a premium. In this case, this premium is higher, between 0.15 and 0.22. So it gives us two options. We can arrive to pay only 0.02 in case we are lucky. So for example, we sell at 0.13 and we buy at 0.15, so it's only 0.2. And worst case scenario is that we sell at 0.10 and we buy for 0.22, so is 0.12 as a premium that we are going to pay from this operation. We can put a limit. For example, in this case the limit is 0.13, but we can decide to put a lower limit like 0.7, and the trade will be done only when that condition will met. for the moment I will not do it, it doesn't matter, we need just to see what happened. Let's submit the order. Again, this is a recap of what is happening, and let's transmit, and it was done. So let's go to see the trade that we did. This two right here is when I booked the two options that I did exactly 10 minutes ago for the purpose of this video. But let's focus on this line right here that is called, they call it diagonal, which is the trade of the roll. So it's like, usually there are the two legs written in the same line. And if we click right here, we see exactly what we did. So we sold the call at 0.11, it was the price, it ended up 0.11, and we booked a new call at 0.2. So at the end we have a 0.9 as a price. So in this case it happened what I explained before on the video. We didn't want to lose the premium that we paid for the call that was going to expire worthless, probably in 2 days, and we decided to extend. And to do it, we sold the call we already have and we booked a new one, so it was cheaper than just wait expiration and buy another call. So that's the reason why you roll a call option exactly in this case, because you want to give more time to the stock or to the ETF to reach the strike price, which was your idea of trading. I hope it's clear. If it was not clear, as usual, drop me a comment. Before to move to the desktop app, if you didn't subscribe to the channel, if you think this kind of tutorial are useful, please subscribe, leave me a comment, tell me what you want to know about Interactive Broker or maybe other brokers that I have where I can do other tutorial, and let's see. So here we are in the desktop app. On top you see my two options. Again, this is the Craft Times, the one I just rolled before. You can see that the expiration date moved from 11, that was before, to 17. So this is the new call. And now let's let's try to roll the covered call I have on XLF. Again, it's a covered call. We see that the position then is negative because we are short in this case. But again, this is not margin account. If you are wondering, I can short a position if I own 100 share of the same position. This is why it's called covered call. So we go down right here, we see that I have XLF in my portfolio. Where is it? Here. So you see I have 100 share, that's why I can short one option. So let's enter in the option. Here the system is a little bit different. Honestly, I like the way of rolling more on the TWS, even if I like much more the desktop app comparing to the TWS. Here is the covered call I have, position is -1, and we have this button right here that is called the rollover. If we click it, here is already highlighted the covered call I have. You see I can close the position, I can roll over. Here and on the top right here I have basically the exact same feature and information that we have in the TWS, just it's presented a little bit different. You see the rollover, there is the first leg where we need to buy the call that we have it. This is the opposite of what we did before. We need to first buy the call and after sell another covered call. The call we need to buy is this one because this is the one we have, we cannot decide. Price at the moment is between 0.9 and 0.94 and 0.97. So we can do different things. Let's try to do something that produces me a gain. So to buy this one, it's clear. Let's move further in, for example, 23 days. And instead of 45, we raise a bit the strike price. So if now we have 95, 97, we need to go like 100, like 45.5. It will be already okay. So, and we decide to sell at 1.21, 1.23. So let me click right here so we have a more clear information. So we buy at between 0.94, 97. So we pay, because we need to pay this premium to buy back, but we sell it at 121, 123. So at the end we have a gain from this operation. We move it the expiration date, we raise a little bit the strike price, and we get also a nice premium. Why not? Here is in negative, but you don't need to be fooled. You should look at the in the opposite way. This is a gain that we will have, is a premium that hit our account of 0.24, more or less, depending on what will be the exact position, depending on what will be the exact trade. So let's submit the order. Again, this is a recap, and there you see a total of 24 point something minus commission, 24 point something, so should be quite okay. Let's transmit, and
order filled.
Transmitted and filled. Let's now move to the trades, just to have an idea of what happened. These are again the one we sold in the WS in the previous segment of the video, and this is the new diagonal one. This is the new roll one. If we click right here, we see the two leg of the option. So from one side we booked the call on 17th of April and 96. We sold a new call on 2nd of May at 1.21. We paid a bit of commission, but at the end we end up with a premium. So that was easy, right? Nothing too complicated. But wait, before to wrap it up, I want to give a big disclaimer on option rolling, which I think is very important you to know. Rolling can be very useful in many situations, but it will never save you a bad trade. If you are bullish on a stock and you buy an option and the stock is going down and your thesis was completely wrong, rolling it forever, it will not solve the situation. Rolling an option every week or every month, hoping that sooner or later it will reach your strike price, that's not an option strategy, that's stupid thinking. Personally, I only roll option when I am on the edge of a trade and I need more time or a better strike price. But if my trading thesis was completely off, I take the loss and I move on. So I hope this video was helpful. Let me know in the comment if you have any question about option rolling, or if you want me to cover some aspect of the rolling option. If you didn't subscribe to the channel, please do it because it helped me a lot, and see you to the next video.